Hey, what's going on, everybody? It is Wednesday, January 4th, 2023. Markets bounced back today. Actually, I was a little bit disappointed at the rebound. I thought we'd be up more yesterday. Yesterday actually was the day that we got those first of the month payments. I have to admit, I thought they were coming in on Friday because normally the process is, if the government makes those first of the month payments on the first of the month, unless the first of the month falls on a holiday, and then it makes it on the first business day before the first of the month. That should have been Friday. But anyway, that's neither here nor there. It was 110 billion of leading spending flow. It was ended up to be like 47, 48 billion of net flow after taxes. We still, believe it or not, we still have, and by the way, that 110 billion included a 24 billion Social Security payment. And I might add that Social Security payment, which is the first Social Security payment of 2023, that's already up 10% over last year. So it's what I said. We're already starting to see that. The increase in the income transfers, not just from the interest income transfers, but Social Security. So 2 billion times 4 times every month is 8 billion times 12 months is 90, almost 100 billion, like I've been saying, additional this year. But believe it or not, even with that, big day we had yesterday, we still have 8 billion to recover from the December 15th tax drain, which just shows you how destabilizing these tax drains are. Now, hopefully, as I've been saying, that the fiscal expansion this year will start to mute some of the negative impact of these tax drains. But yeah, they're really, the other thing is employment and withholding tax deposits. I've never seen anything like it. Here's a chart. It's just blowing through the roof, which kind of suggests that the December job number is going to be really, really strong. Both in payrolls, a lot of seasonal hiring in December probably, and also wages going up. So the monetarist zombies, if that happens on Friday, they're not going to like that. By the way, today what happened was the market came down. It was up over 200. Dow was up over 200 points. It came down, went negative for a while because the Fed minutes from the last meeting came out, and what was in there was basically we're going to keep rates higher for longer. And so, of course, that's reflexive reaction by the monetarist zombies. They're just going to sell. So we're going to see that on Friday, too. It's going to be a strong job number, and they're going to sell, but you got to go against that. Anyway, let me get into something. Folks, it's very, very important, and what I try to really, impress upon you here at this channel, what I try to teach is, to be like a scientist, to open your mind, to really delve into these things, to ask questions, and not just go with, the status quo, with the mainstream, with what the media says, everything like this. And I think that, I know a lot of you guys, a lot of you people here who follow me, and there's not a lot, let's be honest. But I know you guys, many of you are into it, and I have to say that I'm impressed by the change in the quality of the comments. Like if I go back just a few years, the comments was like, "Oh, Norman, you're an idiot," this and that. A lot of, ad hominem attacks, like you're an idiot, you stupid, name calling, you don't know what you're talking. A lot of it now is, we get it, we understand how, some of you even add to what I've given in the videos, etc. And that's great. To me, it shows progress. If I'm going to gauge the channel, I know I whine every now and then about how nobody watches this thing, but I have to say, I am impressed by, the quality of the comments and how people are latching on. But anyway, I want to talk about a comment that was put up here. I'm not trying, believe me, folks, like I'm not trying to embarrass anybody or anything like this, but I think this is part of the learning process. So guys, yesterday I did a video and I put up charts and I showed how, when reserves, QT, the Fed reducing bank reserves, there's this automatic belief, this axiomatic belief, which is wrong, by the way, that's automatically negative. It's like taking away the punch bowl. It's reducing liquidity, all this stuff. Like this is the built-in, this is the monitor, not just even the monetarist belief or understanding. It goes back to the idea of loanable funds, the loanable funds theory, that there's only a finite amount of funds, money available, and the Fed drains it out, then banks can't make loans or whatever. But that's not true. Loanable funds, basically is something that is attached to a fixed exchange rate or a gold standard or something of that nature. It doesn't apply to floating exchange rates where the government is a monopoly issuer and where all of its liabilities are denominated in its own currency. It's just not. There's no application of the loanable funds theory here. So anyway, you can't look at that decline in reserves and say, oh, that's automatically, axiomatically negative for the stock market. It's not. But somebody said, yeah, and then they said, like, look at what happened in 2020. The Fed increased its balance sheet by 50% or whatever, and the market went straight up. Yeah, the market went straight up, but at the same time, you had a 3 trillion, you had, what was it, like an 80% increase in fiscal. The government was sending out checks to people, I have my kids, they were in college, they were getting checks, like, government was sending out checks to people. To say something like that, and again, I'm not trying to attack this person, but it's like you got to open your mind, man. It's kind of like saying, oh, the streets are all wet today because the river overflowed. Okay. Well, the part you left out is that it rained for the last 5 days, and that's why the river overflowed. I mean, you had a 3 trillion expansion in fiscal support, literally checks, 3 trillion of checks going to people. And you're telling me about what, that the Fed increased its balance sheet? First of all, if the Fed increases its balance sheet, it does nothing for the supply of money. I mean, it's taking away, the equivalent amount of government securities, which are that's basically reserves, like I said, with a term and a coupon. So it does nothing. So please, folks. And again, this is not a criticism. I want you to open your minds. I want you to understand this stuff because look, you're going to be faced with this every single day because this is by far the majority view out there. The majority view out there. Now, along these lines, I'm going to play you a little clip of some economist here, and she was interviewed on CNBC, and she said, chief economist, by the way, chief economist. I'm sure she gets paid a lot of money. And she said that, like everybody else, basically, hey, there's going to be a recession, but it's going to take a long time to develop because, people are sitting on a lot of cash and they have to spend the cash first. They got to burn through that cash. Here's the clip.
I think growth will also decelerate. In fact, I think we will go into recession. It's just going to take longer than everybody seems to think, in large part because there's a massive cash cushion among consumers and corporates in the U.S. And so we'll have to burn through that cash cushion before consumers in particular really start retrenching. Also,
so here we go again. It's like when people burn through their cash, when they spend their cash, she's completely lost on this point. Okay, this is like what I was saying before. Oh, the streets are flooded. Yeah, why? Well, it rained for 5 days. So she doesn't understand that, like, when people burn through their cash, spend their cash, that spending goes to someone. So it's just a transfer of savings, a transfer of income. It's like, and listen, she's a chief economist. That's a high position, at least. Like if you wrote that on a resume, or if you wrote that on a I don't know what, a loan application or something, or a mortgage, and people will be like, oh, impressed. Oh, I'm chief economist. Probably makes a lot of money in salary. But if you think that's bad, you know, I've given examples in the past about how Fed presidents, Neil Kashkari, said, like, we have high savings because nobody goes to the movie theaters and the restaurants. He said that during the pandemic, not even understanding that if I don't spend to go to the movie theater and the restaurant, then the income and the savings of the movie theater owner and the restaurant owner goes down. This is the problem with this single variable line of thinking. And again, I don't necessarily blame people, because it's been so hammered into their heads. They look at everything through this prism of monetarism, and which they don't even really understand, right? They don't understand, like, rate hikes equate to interest income transfers at a high level now. That part they don't understand. They just think, oh, we got to pay higher rates. Yeah, we got to pay to whom? Somebody's getting those higher rates, and somebody's receiving those higher rates. You see? So it's, look, 500 years ago, that kind of thinking may be applied. Single entry accounting, but it's double entry accounting. For every act, you know, physics too. For every action, there was an equal and opposite reaction. Somebody asked me today, actually a subscriber asked me today, is like, Mike, is there a way, maybe there's a way that big players can influence a recession? And it made me think, like, let me think about that. Like, stocks, knocking them down, big players? Not really, because what does it mean when the stock market goes down? It just is, once again, it's like, you got to look at both sides of the coin. Once again, it's like a redistribution of assets. It's like some people hold less stocks and more cash, and some people hold more stocks, the buyers on the downside, and less cash. The total quantity, like, again, if we use the swimming pool analogy, and I always want to keep you focused on the swimming pool analogy, because I think it brings it very much back into an understanding that's really simple. Did the water in the pool go down? No, it's the same. It's like you have a certain quantity of assets, stocks and cash, and now some people get out of their stocks and they have cash, and some people have stocks now, like me, I'm buying. I have more stocks and less cash. It's like the swimming pool is the same. There's no change. So I'm thinking, no, that's not really going to do it. You know, it might get people scared. That's a point I'm going to address in a second. The other way is to have some kind of a really, really large drain of income. That will cause a recession. How can that happen? It could happen with massive taxation, like the government tries to now run a surplus. By the way, just as a side note, the GOP in the House, they still have not picked, as far as I can, up until the recording that I'm making right now, they don't have a Speaker of the House. And, some of these, like Jim Jordan, I don't know if he's, in contention, but, he's all about, like, he thinks of the government like a household. In fact, he tweeted something today like that, like, hey, we all got to balance our books. What's different about the government? Well, Jim, you're a dummy, man. We're not currency issuers. So some kind of a massive decline in income, a drain, taxes. I don't see it happening. Look, we just had, I don't know if I did mention this, we had a big increase in the Social Security payment just yesterday. All right. And of course, the interest income transfers that are going up. So I don't see that happening. The other thing I kind of alluded to is like if the stock market goes down, will that cause people to pull back? Will that cause people to sit to suspend their consumption and just everybody does nothing? I mean, if that happens, that could cause a recession. But again, I just think like if your income is going up, and I understand not everybody's income is going up, but I mean, if you're in, if you're getting now 5% on your T-bills or whatever, I mean, that income's going to be spent. I mean, it's hard for me to envision a scenario right now where more income is being put into the economy through these government transfers, and yet people pull back. I mean, if the government now started to run surpluses, yeah, well then that is a forced drain on income. That's literally taking it away. Just taking it away. You have no choice. Even if you want to spend, it's not there anymore. But when they're adding it in, you mean to tell me that everyone's suddenly going to say, I'm going to pull back? I don't see it. I don't see it. The other way, the third or final way I should say, is some kind of something, some event, some reality that impacts the productive ability of the economy. And I would have to say, we've been through that with the pandemic. Like things were shut down, supply chains were shut down. Even if you wanted to produce, you couldn't. Right? Because we couldn't. Everything was shut down. So like, if something came along, an embargo, energy, I don't know, war, I hope to God not, but something like that. That's I would put that out on, like a tail, what do they call that in probability, fat tail event or something like that. I don't see it. I just don't see it, man. Okay? So people, please, when you hear stuff, try to think about, well, I'll boil it down for you. Physics. For every action, there's an equal and opposite reaction. Try to think about what that equal and opposite reaction, or what that simultaneous offsetting, because there always is. The only time there's not, really, when the government takes it away from us. And it's not happening. I'm not saying taxes are too low. They're not. We absolutely need to cut taxes, especially like when you saw that chart I just showed you of the employment taxes blowing through the roof. But I mean, I just don't see it. Anyway, that's it for today, folks. Enjoy. Bye.